Grace, it's great to have you with us. So obviously we've seen, there you are, yay. We've seen financial markets crashing in the past week. Could you tell us a bit about what this means? What should we be prepared for, and what should the left be demanding?
So the first thing everyone will have noticed has been the massive collapses in stock markets all around the world. So equity prices, stock prices have fallen in the US, in the UK, across Europe, Japan, etc. And a lot of those falls have been bigger than the ones we saw in 2008. You know, there have been people saying that the collapse in some places has been the biggest in several hundred years. Now, partly that's to do with the severity of the crisis on the real economy, which I'll talk about in a bit, but partly that's because most of those indices were overvalued before the crisis. We've had a kind of decade of stagnation in the real economy. So like pretty poor productivity, stagnant wages, low levels of investment. That's true for the UK, but also for many other advanced economies. At the same time, we've had the government, central banks around the world pumping liquidity into financial markets, which has pushed up asset prices. So, you know, equities, even, you know, housing prices, as well as making debt quite cheap and kind of creating a bit of a bubble in corporate bonds. So the fact that equity prices were already high and stock prices were already high means they had further to fall. And a lot of people were saying, you know, this has been a really long rally that we've had in stock markets since 2008, as well, since 2009-10, even as the actual economy has stagnated. So people were kind of waiting for this hit to come, and now it's come, but it's been much more severe than most people were expecting. Having said this about the equity markets, they are, you know, the fact of the collapse in stock prices is not the thing we should really be focusing on. The reason that stock prices are collapsing is because investors are anticipating a really big recession. So obviously stock prices are supposed to reflect the expected long-term profitability of the companies that investors are putting their money into. The fact that they're taking all their money out suggests that the real economy is going to go into recession, and those businesses are going to stop making profits. Now, why do we think that the real economy is going to go into recession? Well, there is obviously going to be the immediate impacts of people self-isolating, which will mean a massive disruption in the labour market. So lots of people just either unable to go to work because they are self-isolating, because they're hospitalised, because they're, you know, social distancing, whatever. That's a really big disruption that's going to have an immediate effect on output. But it's the kind of secondary issues that could be the biggest and most long-lasting. So I'll start at the kind of macro level and talk a little bit about something that you might have heard people talk about, which is corporate debt. So I kind of mentioned that that loose monetary policy, so that means very low interest rates and quantitative easing, that has basically given us a corporate debt bubble in the US and the UK. Basically, businesses have found it very cheap to borrow money. Firstly, because interest rates have been very low, but secondly, because investors have been what we call reaching for yield, so looking out assets to put their money into. And a lot of them have put their money into very risky corporate debt, i.e., maybe so you've been buying corporate bonds that aren't rated very highly, so that, you know, maybe aren't a very good bet in terms of the long-term sustainability of that company. They've been doing so on the basis that firstly they didn't have very much else to invest in because the real economy hasn't been doing very well, but secondly because we've been experiencing this boom in financial markets, at least partly driven by government policy and central bank policy, which investors didn't expect to end for quite a while. And which, you know, is not, you know, that loose monetary policy is not likely to end for quite a while. But obviously the severity of this crisis has created the kind of shock that has pushed everything off course. So the fact that we've got that shock now, along with that corporate debt bubble, is a really big potential systemic risk. Because obviously corporations that have a lot of debt, if they face a kind of fall in their incomes, then suddenly they're not going to be able to pay their debts. And then you get into a situation where lots of corporations are going under. When lots of corporations go under, the banks that lend to them and the investors that have lent them money then also face problems. Now, that's going to be less of a significant issue today, perhaps, the issue of the financial system than it was in 2008, because banks have a little bit more capital to be able to absorb those losses because of the changing regulation that we've seen since the financial crisis. But it's still a potentially really big issue. And this is largely why we've seen a lot of the attention on loans to businesses because of that big corporate debt problem. Important to remember that that corporate debt problem has been driven by government policy over the last 10 years, and it's actually, you know, not going away anytime soon, even with that relief that the government's going to be providing. The second issue is also sovereign debt. So, you know, we could see some countries that are in a less kind of powerful position in the global economy, unable to pay their debts, and that is obviously potentially could create some really, really significant problems for some major economies in the global south. And obviously we know what happens when countries in the global south get into debt problems. The IMF sweeps in and says, yes, you can borrow some money, but only if you implement these neoliberal policies, you know, cut public spending, cut your debt, implement capital mobility, all these different sorts of things. So that's also a real problem on the horizon that we need to be looking at. Then there is the kind of, I suppose, issues that are a little bit more closer to home. And that is the problem that kind of problems that we've been talking about already on this call, which is the impact that this kind of immediate contraction in output and the disruption in the labour market could have on people's incomes. So we've got corporate incomes on the one hand and then personal incomes on the other. Now, obviously, statutory sick pay, not nearly enough for the vast majority of people to be able to pay their rent, bills, survive, etc. So that's one thing. But obviously, you've got the other problem with the fact that statutory sick pay doesn't apply to a lot of workers, the self-employed, you know, potentially people on 0 hours contracts who just don't get new work. And they could potentially be facing the loss of all of their incomes. You know, freelancers, pity us poor, you know, freelance journalists who are, you know, are facing a loss of speaking events and that sort of thing. There are going to be lots of freelancers, contractors, people working in the gig economy in particular, who are going to see a complete collapse in their incomes. And that is obviously not going to be counteracted by statutory sick pay, because the problem isn't that they're having to get off work to self-isolate. The problem is that, you know, people just aren't ordering Ubers, you know, ordering speakers and etc. for events or going out or whatever. So that potential loss of income for some groups is going to be really significant. Then you have just the longer term issue of that contraction in demand, which could mean that you know, wages fall and businesses start having to lay people off altogether. Now, these are even more significant problems because households don't have any savings. What we've seen over the last 10 years is a decade of wage stagnation, along with rising housing costs, a lot of rising, other rising costs of living. And people, so in 2017, it was the first year that people spent more than they earned since 1987. And that was for a very long time. So people have been drawing down from savings for a while. They've been taking on new debts, which puts them in a very fragile situation. Similar to those corporations, if they face a big loss of income, there's the potential they could default on their debts. So all these people facing a loss of income, which is a big swathe of the population, are threatened by obviously the immediate issue of a loss of income, the secondary issues of being unable to pay their rents, unable to repay their debts, bills, etc., which could mean homelessness, bankruptcy. It puts a lot of people in this country in a very, very severe situation. That obviously has distributive impacts now, but when we're thinking about the long-term impact on the economy, you know, the people who are drawing down all of their savings and taking on debt to survive this crisis, they're going to have to deal with that at some point in the future. So a lot of people are saying, oh, it will be fine, it will just last for 2 quarters, then we'll get out of a recession. Actually, no, the impact on people's incomes, if we don't see significant income support, is going to last much, much longer. And all of this together, so the combination of the fact that, you know, you're going to have a contraction in corporate incomes in the context of high corporate debt, a contraction in personal incomes in the context of low wages and high personal debt, and potential issues around the financial system, means that a huge amount of pressure has to be put on the government response. Because if all of these things explode altogether, I mean, you basically start to see an economic collapse far, far worse than what happened in 2008. What we've seen today is government stepping up to provide loans for businesses. That's trying to stop the first problem, which is trying to stop that corporate debt bubble from blowing up and impacting the rest of the economy. What we've not seen is really any action whatsoever on that second problem of personal incomes. That is really, really going to be very important. And I think, you know, just as a general point, I think I might be getting close to my time now and I don't want to go over. As a general point, lots of people are panicking at the moment about like the relevance of the left, because we had this fairly, you know, what was portrayed as a generous budget from Rishi Sunak last week. But actually, you know, we need to bear in mind that the Conservatives are not suddenly turning on the taps because they've realised that their approach to public spending was wrong. What they're trying to do is what they always try to do, which is to protect the interests of their backers and their electoral coalition. So the Tories are going to try and deal with this crisis by protecting the interests of capital and by protecting the interests of their voter base, which is largely older middle-class homeowners. That is why we're seeing corporate bailouts, and it's why we're seeing relief for mortgage holders. They're not going to do anything to help most people who are still of working age, people who have significant debts, people in the private sector, etc. That's most of the population, and that's really who we need to be organising. What we're going to see, obviously, is yes, an increase in government spending, potentially, you know, an increase in spending on public services, an increase in spending on infrastructure, etc. But that is not going to help the vast majority of people, and it's certainly not going to deal with the long-term economic impact of this crisis. At the moment, it does seem as though the UK and even a lot of other governments around the world actually are being a bit complacent about the potential impact this could have. They are not thinking about the kind of domino effects that big contractions in income and contractions in output can have throughout the rest of the economy, or at least they don't seem to be, because they don't seem to be focusing on that question of personal income, especially not in the UK and the US. So really, you know, for a whole bunch of reasons, because you know, we need to show solidarity for one another, because it's better for the economy over the long term. We know what our demands need to be. So an increase in statutory sick pay, income support for anyone facing a loss of income, freezing rents, freezing debt repayments, money for the NHS and social care. And also, I think there's one other thing we need to talk about, which is that we're going to start seeing a lot of big corporate bailouts, I think, over the coming weeks and months. The worst case scenario, by the way, when it comes to this question of corporate bailouts in the long term, is that we see a lot of small businesses going under, because even with this package of loans, they can't survive this crisis, and big businesses buying up what's left over. We get a massive concentration in capitalism, and we get the growth of the kind of monopoly capitalism that we've seen really develop since the financial crisis, with all sorts of implications for equity and for the stability of the economy. Monopoly capitalism is highly unstable, but it's also a kind of capitalism associated with very close links between those big multinational corporations and the state. And the state is going to be looking at providing no strings attached bailouts, and we need to be really, really challenging that, so we don't get into this kind of monopoly capitalist situation. We need to make sure that when those bailouts are being provided, that conditions are attached, so that big businesses aren't just going out and spending that money on share buybacks, massive dividends payouts, so they're keeping workers on, etc. I think the thing that we need to be... Sorry, I was about to stop. Last point. The thing that we just need to be watching out for is, you know, we've been talking for a very long time about austerity. We need to expand the size of the state, because that is the best way to protect the interests of working people. We're going to see probably quite a big expansion in the size of the state, just as we did after the financial crisis. The question is who those resources are going to be directed towards. And I think that's really where we need to be challenging the government.